Hi everyone, welcome to join today's session. And today we are going to introduce the newly launched Endowus Global Real Estate Satellite Portfolio to you. I am Yuling and I'm the investment lead at Endowus. Joining me is Wei Mei, who is the Chief Advisory Officer at Endowus. So Wei Mei is going to kick off the session for us to get into a bit more details about the Endowus portfolio.
Thank you, Yulin. Hi everyone, it's good to be able to share with you how our global real estate portfolio looks like. If you look at the composition, it is a 100% equity portfolio and we have selected 4 different funds in there. The focus is to achieve total returns that will be made up of both dividends as well as long-term capital appreciation. So currently the underlying dividend yield of the portfolio is between 4 to 6% per annum. And we are also seeking long-term capital appreciation opportunities. In terms of portfolio mix, roughly about 60% of it would be in REITs, followed by 20% in listed real estate companies like property developers, and the other 20% will be in listed infrastructure companies. So I think many of you will be familiar with real estate investment trusts, which are REITs. And many of these companies would own physical properties like retail shopping malls, office buildings, logistic warehouses. And on the infrastructure side, you have exposure to energy grids, toll routes, railways, and also pipelines. And overall, we do feel that in terms of country exposure, it's going to be very much globally diversified. You will still see a majority of it in the US because that's where the biggest real estate market would be. But you're also going to get meaningful exposure to other countries across Asia and Europe at the same time. If you look at the compositions of the funds that are chosen, it is a curated portfolio. So we have done all the hard work in terms of selecting the funds on your behalf. We have decided to select BlackRock, Janus Henderson, and also UOB Asset Management. These are the managers who have got extensive experience and expertise investing in this space. And each of the funds do have their own unique characteristics, such that when they are being put together, you will get a diversified portfolio and you will have managers that can complement each other. And it will cut across both global real estate as well as infrastructure. And I think there is one specific fund that I would also want to point out to you, which is the BlackRock Global Real Asset Securities Fund. It has got a covered call writing strategy that can also help increase the dividend yield of the portfolio. So I think it's really something interesting and worthwhile for you to take a closer look. Now I'll hand over to Yulin, who will share with you why you should be investing in global real estate as an asset class.
Thanks, Wei Mei, for the introduction. Now let us get into the details of this asset class a bit more. Let's take a look at a few reasons why investors might want to consider allocating to this asset class. So firstly, the total return of listed real estate and infrastructure companies are supported by 2 components, a consistent dividend yield as well as long-term capital appreciation. Now let's talk about dividend yield first. So let's look at the chart. The black line represents infrastructure equities and the blue line represents real estate equities. And we can see that historically, both have had consistently higher dividend yields compared to that of the broader developed equity market, which is the dark green line, and also the yield of the 10-year US Treasury bond, represented by the light green line. So there is a reason behind it. The stable and high dividend yield actually derives from the fact that both real estate and infrastructure companies, they own physical assets. And those physical assets, they produce stable cash flows, such as rental income or utility bills. So the level and the stability of the dividend yield for many real estate companies are further underpinned by the legal design of REITs, which are the real estate investment trusts, as Wei Mei explained earlier. And those REITs, they are required by law to pay out the majority of their taxable income as dividends. So if you think about it, this is actually one pretty attractive characteristic of investing in this asset class, because basically you as an investor is able to access the physical assets in a liquid and transparent manner and to receive part of the profit or cash flow of those assets earned through the form of dividends. But just a quick clarification here. So the Endowus portfolio at the moment helps investors to automatically reinvest all the dividends for wealth accumulation purpose. So if one wishes to take the dividends out, you can do a manual redemption of the amount that's desired. Let's take a look at the long-term capital appreciation potential of this asset class, because there seems to be a common perception that this asset class is more bond-like. But actually, as the chart has shown, if you compare the long-term growth of both real estate and infrastructure companies to some high-yielding fixed income asset classes, such as the US high-yield market or the hard currency emerging market debt market, over the longer term, it has produced stronger capital appreciation. And the reason is very simple. It's because by investing in the stocks of those companies, you don't only share their current cash flow, you also have the opportunity to share in their future profits and cash flows, and therefore the growth potential of these companies. And the fact is that the industry is actually rapidly evolving, and there are some very structural and long-term secular trends, such as 5G, e-commerce, aging population, and climate change, and they all have profound impact on the growth and development of both sectors, accelerating the growth of some segments such as data centers, logistic warehouses, and even elderly homes because of increasing aging population. Okay, now another reason to consider allocating to this asset class is its diversification benefit, which will allow investors to enjoy a better risk-adjusted return. And the chart illustrates the correlation of listed infrastructure companies and real estate to other real assets, such as gold and oil, as well as financial assets, such as global bonds and equities. And we can see that both real estate and infrastructure companies, they have relatively low correlation to real assets and financial assets. So generally, investors are perhaps more heavily invested in the traditional financial assets, like equities, but tend to under-allocate to asset classes such as real estate and other real assets. So adding a bit of the exposure as a satellite allocation would help you to diversify the overall portfolio better. Now let's move on to the last reason listed here, which is the potential for inflation hedging feature of real estate and infrastructure companies. So the chart shows the average return of different real assets, as well as for the global bonds and global equities market during periods of accelerating inflation. And as we can see that during those periods, actually both infrastructure companies and real estate companies, they have outperformed the broader global bond and equity markets. So how does it work in reality? In a nutshell, these companies, they offer an effective hedge against inflation because many of them benefit from the high pricing power or even explicit contractual agreements to pass the impact of rising prices to their customers. So for example, for property companies, a lot of property developers, they can actually increase the price of new properties because of the rising cost of labor and materials. And on the flip side, because of the rising cost of developing new properties, the supply is limited in those periods of time, and the tenants can actually have pricing power to then increase the rent to tenants. And for infrastructure companies, actually a study has shown that more than 70% of assets owned by those companies, they have effective means to pass through the impact of inflation to customers. So for example, they might have concession agreements or contracts, or they might be in a very good strategic position in the market to deliver a similar outcome. Yeah, but that said, significant qualitative assessment is still required to find companies with stronger inflation protection within both sectors. Okay, now I'm going to touch quickly on who should invest in global real estate market. And we have illustrated a few benefits of why investing in this asset class, but investors should still be aware of the downside risk and the volatility of such investments. So the memory of global financial crisis from 08 to 09 and more recently the COVID sell-off in March 2020 still stays with many of us. And in both periods, actually, both real estate and infrastructure companies, they were hit quite hard and suffered large drawdowns. Not to mention that actually the global financial crisis itself was a sequel of the burst of the US housing bubble. So let's take a look at the scale of the past drawdown. During the financial crisis in 08, the global real estate market went down by 65%. And during the COVID sell-off, it went down by 26%. In comparison, infrastructure companies, they were a little bit more resilient, despite still suffering a 32% peak to trough loss in the financial crisis and 16% during the COVID sell-off. So to invest in this asset class, one should be able to or be prepared to tolerate pretty high volatility and to have a pretty aggressive risk tolerance. Now let me hand over to Wei Mei to get into more details on the Endowus Global Real Estate Portfolio.
Thank you, Yulin. When it comes to deciding which would be the global real estate portfolio that you want to select, we do believe that the Endowus portfolio would be the right one for you. First thing, many of our local investors do like Singapore REITs, but it is also true that the Singapore market is actually very small. So as a percentage of the global listed real estate market, Singapore is less than 4%. And if you look at global listed infrastructure, Singapore represents less than 0.15%. So it is definitely going to be much better for investors to explore a much wider spectrum of solutions that are out there and avoid the bias towards just allocating to your home country. And in behavioral finance, this is known as home bias. So we do think that the portfolio that Endowus has put together can help you break away from home bias. Today, just looking at market capitalization, broadly speaking, for real estate, it is at US 3.5 trillion. And for infrastructure, it's at US dollars 1.8 trillion. The opportunity set is really exciting. You are going to be able to cover more than 700 companies in over 38 countries and over 23 subsectors. So in a sense, if you choose our portfolio, you are certainly going to be exposed to more than Singapore, more than Asia, and onwards to the rest of the world. Looking now at overall in terms of returns, we do believe that the managers that we have selected are able to add alpha opportunities because real estate and infrastructure is a specialized sector. And compared to just having passive index exposure, the managers have proven that over time they can find good quality opportunities. So the managers that we have within the global real estate portfolio will include BlackRock, Janus Henderson, and UOB Asset Management. And the use of these active funds have proven to you that they can generate a higher current dividend yield of between 4 to 6% per annum compared to what the broader global real estate and infrastructure markets can offer. And that is only at about 3% today. So you could get a higher dividend yield pickup, but at the same time, when it comes to total return potential, this portfolio has been historically able to generate a higher return compared to global developed real estate and infrastructure markets, but at the same time with lower volatility. So I think it's really important for investors to consider that you are able to have a portfolio that is managed well in terms of risk metrics. And also because I think these managers, They do have deep understanding of the dynamics of the different subsectors in each country. They are therefore able to decide on dividend sustainability, future growth, and also any short-term dislocation that they can capitalize on. So many of these things, I think, would be a lot more challenging for individual investors, and you'll be better off if you are going to allow the institutional fund managers to do the heavy lifting for you. And I think the third thing which I want to share with all of you is the fact that when we go through the selection of the funds to put into the global real estate portfolio, we have done thorough due diligence versus the peer group out there. We are also tracking each of the fund's performance on an ongoing basis, and we assess the suitability for each fund within a portfolio context. We are researching on new funds as the market develops. So in the event that there are new funds that can add more value, we will also be supplementing by adding them to the global real estate portfolio or even replacing an existing fund. So this overall assessment will help that the portfolio will continue to be invested in the best-in-class managers and be responsive to ongoing developments as well as new ideas. With that, I'm going to ask you, Lynn, to share with you a portfolio deep dive so you have more details about the schematics of the portfolio.
Thanks, Wei Mei. Yeah, so let's look in much deeper depth of the portfolio itself. And this table actually shows you the detailed allocation of the portfolio, which has been shown before, but it also listed the cost pertaining each underlying fund, as well as the overall portfolio. So just to break down the allocation even further, as we can see that 90% are actually allocated to the 2 global funds, and 10% are allocated to the 2 Asian-focused funds. The reason for that is because the global funds, they already have allocation to Asian market. So this portfolio does have a slight tilt to the Asian property and infrastructure markets. The reason being that Asian offers a slightly higher yield than the global markets, but we don't want this tilt to be too significant, hence the current weightage. And in terms of the cost, for all 4 funds, we either use clean share class with no rebate, which is the case for BlackRock Global Real Assets Securities Fund, or we use retail share classes with 100% trailer fee rebates. So we pay all the trailer fees back to Endowus clients so that on a net basis, we can achieve the lowest cost for our investors. And as you can see, the net total expense ratio for Endowus Global Real Asset Portfolio is 1.15%. And this slide compares a longer-term portfolio return to various benchmarks. So as mentioned before, the Endowus portfolio has a strategic asset allocation of 80% in property and real estate names and 20% to infrastructure. So we actually constructed an 80-20 benchmark to compare the portfolio to. So note that the underlying funds, they were incepted around different times. And prior to the fund's inception, we populated the representative historical data consistent with our methodology in order to show investors a longer-term view of the risk and return of this asset allocation. So for the past 3 and 5 years, which is when most of the underlying funds have been around for, the portfolio has actually outperformed the benchmark quite impressively, most likely due to the active management nature of the underlying funds. And for a longer period, our asset allocation's risk and return is pretty in line with the benchmark, which is what you would be expecting. Finally, we would like to show you some of the names, the detailed holdings within the portfolio. As you can see that the portfolio really does cover a variety of names, both in newer sectors, up-and-coming sectors, and more traditional sectors. So some more familiar names can be, for example, CapitaLand in Singapore and China Tower in China, as well as GDS Holdings, which is, I think, getting increasingly popular because data center is now very hot. So it is a data center operator with assets primarily in China. Looking at this allocation, which will of course dynamically change in the future as well, investors can take comfort of the diversity and of the fact that fund managers actively search and position the portfolios for the best opportunities they can find globally, both long-term and more shorter-term technically. Okay, so here comes to the end of the presentation. Hope this session has been helpful to you. And if you want to learn more about Endowus Global Real Estate Portfolio, please check out our Insights article link.